Welcome back to the episode number 4. For Warren Buffett, the compound interest is the eighth wonder. For me, in a very humble way, the ETF is the ninth wonder. What is an ETF? An ETF is exchange traded fund. Probably you will have already found in many videos, in many news. But in general, it's an investment fund that holds multiple assets. It can be bought and sold as an individual stock and multiple times a day. Now let's take an example of the VO. VO is the Vanguard ETF that tracks the S&P 500. It uses an index approach as a philosophy of this ETF. Now, the S&P 500 index is widely recognized benchmark of the US stock market performance. When you hear that someone has beaten the S&P 500 or has outperformed like Warren Buffett, it means that the performance of Berkshire Hathaway were much better or better than the S&P 500 index. Now, S&P 500 means the first 500 stocks, or let's say companies, per capitalization in the US. Let's take an example with this VO. We have different kind of sectors. For instance, technology is at 32%, then we have financial services. So technology is the most, let's say, important sector in the S&P 500. And now these are the top 10 holdings, more or less 35% of the index of the S&P 500. The first one is Apple, then we have Nvidia, Microsoft. So the technology sector is quite, let's say, overweight inside of the S&P 500. So when you buy an ETF, it's like if you are investing in all these companies. So here you have a very good diversification, different sectors, not geographically because it's only about the US, but you have a very good diversification among all the, let's say, 500 most capitalized companies in the US stock market. Now, what is an asset? Because we hear a lot of time word asset. Asset is a resource with economic value, and it is expected to provide a value in the future. It can be a land, it can be a building, it can be a machinery, it can be a stock, it can be a bond, it can be a patent. So something that represents, that has an economic value and then can provide value in the future. Now, assets can be tangible and intangible. Tangible asset is an item with a real physical form. It can be a land, a building, a machinery. And then we have intangible assets that are non-physical items like a patent, a brand, a legal contract, a copyright, and so on. Intangible assets usually are more liquid than tangible ones. For instance, if I have a stock or a bond, I can sell it quicker than basically a building, than a land. Now, how could I explain this to the concept of asset to a kid? But it's something that has a value. This is an asset. And what about the financial securities, like bonds, stocks, derivatives, and so on? Well, they are tangible assets. In general, financial assets are between tangible and intangible. But they are a claim of ownership of an item. But we can have a financial asset, for instance, a stock can represent part of an apple or part of a real estate. So it's quite different what that stock represents. Because in case of Apple, we have a set of patents, we have buildings, we have products, we have a brand. In the real estate, it's quite different what is represented by a stock of a real estate trust. Now, in general, when we talk about financial assets, we say that they are tangible assets because the IRS requires a business to report financial and real assets class as tangible assets. So, in order to avoid any kind of, let's say, doubt about what is an asset. Now, let's go next, talking about ETF. Basically, why ETF? Why, for me, it's the nine wonder? Because they offer diversification with respect to geography, sector, industry, capitalization size. So you can build a portfolio diversifying by geographic area, sector, industry in a very easy way. That would have been quite difficult, if not impossible, to do it with single stocks. So for this reason, they are really great, and then you can buy them as a normal, simple stock. You can buy, you can sell in a very easy way during the day. Diversification is what offers a kind of protection against the, let's say, when the market goes down. Now, there are different ETF types. Here there are some ETF that for me are the most important types. Market cap index. They try to match the performance of an index like a VO, SPY, SWDA, and basically VO and SPY, they track both the S&P 500, SWDA tracks instead the MSCI World. Now, the next category of, let's say, the next type of ETF are related to sector, industry, ETF. Basically, they provide exposure to a specific industry, like, I don't know, a pharmaceutical company or technology. Here we have the VDI, VFH, well, there are, let's say, many of them. Then we have dividend ETF. And usually they hold the stocks having history of high dividend distribution. We can have aristocrats, we can have a company, they're dividend king, or we can have just high dividend distribution, let's say, companies. Probably one of the most famous is SCHD from Schwab. And then we have the VYM from Vanguard. Sorry. These are just some kind of examples. Then we have a team ETF. They just collect a set of stocks of a specific team, like a defense, ESG, AI. About, for instance, defense, we can have stocks from automotive, we can have stocks from technology, and so on. Then we have style ETF. They track an investment style like value or growth. For instance, we have the VGT, so the Vanguard Growth, and then the VTV. And then finally we have the bond ETF. They have non-equity ETF because they have inside only bonds, and most of this ETF, they don't have a maturity date. When an ETF, when a bond arrives at a maturity date, it's just replaced. And here again we have different kind of ETF. Can be long-term, short-term, and mid-term. Can be related to a municipality, to a company. Can be related to, for instance, government, and so on. Now, what are the key points for me now Then we will explore a bit better the ETF in the next episode. First thing is the asset distribution, because I can have a very huge diversification. I can have a different diversification, concentration with respect to sectors, geography, and so on, that with the normal stocks I cannot do. And then we have low fees. Usually I consider 0.5, even if at 0.5, my personal opinion, it's already quite expensive. But for instance, the VO costs something like 0.03, so it's not, let's say, so expensive, it's very cheap. And then usually for me, it's good when it's around 0.1, 0.2 max. But let's consider 0.5% a year as a kind of top, let's say, fee that we should consider. For me, ETFs are building blocks of a portfolio because they offer diversified investment approach. And this is very, very important. When you build your own portfolio, use them as a building blocks. And in general, the ETF you should find what matches your investment strategy. So means objectives. Of course, our objective is to increase our basically our value. Okay, so the money. But then you have to consider really what are the objective is. If you are young, if you are 20 years old, probably you have 40 years in front of you. If you are 60, probably you have 10, 15 years as objective. So consider what are your objectives. We will do a video more interesting and more, let's say, detailed about that. And then also the risk, how much you can tolerate. Can you tolerate something like a minus 45, a minus 50% value of your portfolio? Yes or no? So the important thing is, at the end of the day, that we sleep well. So thank you very much to follow me in this part. In this episode, please write in the comment, subscribe, and tell me what you would like that I talk in the next episode.